In our field, it's easy to murder a lot of people, but it's very difficult to hide the bodies. There's a real estate company whose net worth, when I was looking at that point of time, was less than the money they've raised in the market. Yet every year they had shown the profit. So where did the profit go? If it walks like a duck, if it quacks like a duck, it's a duck. So you always, there is no scope for aggressiveness in accounting. I have owned many hundred baggers which I sold early. And you know what was the reason? And it took me 20 years to figure this out. So it's not trivial as for me.
So how do you distinguish between the opportunity cost of the next buyer versus the greater fool theory?
This is a very loaded question. Mahalakshmi, when you walk down the hall of greater fool, there is a mirror at the end. And that mirror looks at you.
Hello and a very warm welcome to The Wealth Formula. I'm Mahalakshmi and I have with me today an accomplished value investor who wears multiple hats, an investor, a teacher and an entrepreneur. With more than 3 decades of experience in public markets, he was earlier a partner at Sage One Capital and now runs his own investment firm called Oak Lane Capital. He teaches at the Flame University, Pune, and his entrepreneurial endeavor involves developing an AI-assisted tool called Needle.ai, which helps you filter out the unnecessary information and cut out the noise, which is, of course, very important for all investors. So here he is, Kuntal Shah.
Thank you for having me here.
Kuntal, thank you so much for joining me. It's such a pleasure to have you here at the studio. First of all, take us through your journey. How did you even get started in stock markets? Because you were qualified as an engineer.
Yeah, so I've happened to be engineer by qualification, but my engineering job lasted for exactly 1 day, actually. So I joined a firm called TVS Electronic and resigned in the evening, fully knowing that the work was not cut out for me. Mahalakshmi, this is now we are talking of an era, 1992, where the computer memory was in KBs and, there were not too many opportunities in that field. We were just coming out of Harshad Mehta's episode where, some of the cement stocks went berserk in terms of valuation on the basis of replacement theory and so on and so forth, which later obviously we realized was diversion of banking funds to the stock market. But at that point in time, I had access to people who were actually running cement plants and, in fact, even the MDs of ACC and at that point of time, and even they didn't know what was happening. So it sounded very, bizarre in the sense that person who started his career as ACC engineer is the top person driving the strategy and outcomes as ACC, and he didn't know why stock market behaved the way it is. And I thought if you could figure out, it would be a very satisfying career and a good puzzle to solve. So curiosity actually forced me to.
But how did you even think that you could figure out something that the ACC MD could not figure out at that time? What gave you that confidence?
Well, I was young and maybe overconfident at that point of time. Looking back, it now looks really stupid. But when you are young, you tend to do a lot of foolish things. You are overconfident, and I was one such.
Cool. So before going any further, how did your family react to your decision to get into stock markets after doing an engineering?
Well, in 1992, a lot of close family who were in stock market actually lost their entire fortune. So their view, and rightly so at that point of time, was here's this guy.
You had people in the family who were
a lot of families, coming from a South Bombay Gujarati family. I had a lot of relatives who were actively involved in the stock market. And many of them had a misfortune of being on the wrong end of the curve in Harshad Mehta's scam-related stuff. So rightly, they were very worried that here's a guy who's a wannabe and who wants to make a quick buck and is letting go his career in engineering to pursue something, meaningless or, passing the paper around. And it was not so well received. Okay. But the curiosity still prevailed at the end of the day.
So we can talk about your wealth formula, of course, Kuntal, but what I want you to first talk about is the 12 equations or the dozen equations that are the guiding principles. You've articulated about this in 1 or 2 videos, but nevertheless, it's hard for me to resist asking that question because it is so good.
Let me do something better. I feel there are 3 types of investors. There are narrative-driven investors. Which look at, longevity of the business, the quality of management, the competitive positioning. They look at all the qualitative factors surrounding good businesses they are not numerically literate. The narratives drives the investment philosophy, the market share and all. Narrative is far more important than the numbers. Then there are numbers driven, they want to know the next quarter's margins, the sales growth, the capex. You see a ton of them when the conference call, congratulating management for the good set of numbers and then waiting to fill that Excel to come out with some targeted price. Now, numbers are good, but if you can't connect numbers with the accounting beneath it, then it can give you some very funny results. So let's talk about these equations of accounting this time, which I think so many of the investors miss to their detriment, and they'll end up getting caught in the wrong side of the stick. So let's look at the first equation of how do accounting shenanigans happen. Let's go to the behavior part. What do management want to portray? Rising earnings, consistency of earnings. So what is the earnings equation? Income minus expense plus gain minus loss is equal to earnings.
Right.
So on the balance sheet side of the same equation, which is linked to the umbilical cord, assets minus liability is equal to equity. Now, if you want to portray better than rosy picture, you would want to bump up the earnings. So one corollary of that is your cost and liabilities will be rarely overstated. The corollary to that is also that your assets are likely to be overstated. Now, when you put all these things picture, let's look at one by one each of the component. So to boost the income, some management will resort to booking fictitious income. Some will prepone the income from the later period to current future. Some will have a lot of accrual accounting, income which is not realized but booked, so on and so forth. Then look at the expense per side, which is the more expense means lower profit. So obviously the easiest way is to push the expense to a subsequent quarter. Or capitalize the expenses on the balance sheet item, so on and so forth. Then gains, one-off gains, or you postpone. Some of the management now even postpone the gains to a later period to show consistency, because businesses are volatile. But market overvalues consistency of earning. 20% growth for 18 quarters, 20 quarters is more rewarding and less brain engaging exercise, right? You can just predict come up with this DCF model. So with that, or exceptional loss, or if you see the accounting standards have been changing every 5-6 years. 2007-8 there were changes, 13-14 there were changes, 16-17 when we moved to IFRS changes. Now let's look at any metric which an analyst values. It's likely to be gamified. Now one of the most ones say let's say ROE. ROE is profit divided by the net worth or the capital employed, right? The equity capital employed. Now profit is an estimate. There is a saying that top line is vanity, margins are sanity, profits are an opinion, but cash is king. So in our field, it's easy to murder a lot of people, but it's very difficult to hide the bodies. Now these bodies are always kept in cash flow statement. So if you want to overstate PAT, you can understate the expenses, defer the expenses, capitalize the expenses, not provide for warranties, have lower depreciation, n number of things to improve the number. Retained earning. We did an analysis 2 years back where we took Nifty 50 and BSE Sensex 30 companies, went all the way 20 years wherever the record was available, and just did a basic reconciliation check of retained equity, where we said opening equity plus income, which is again income is income minus expense plus gain minus loss is equal to net income, minus dividend and minus buyback, the capital you return to the investor, and add the capital which you raise from the market, should be equal to the closing retained earning, right? Doesn't happen in at least 82% of the companies. The numbers tend to be fudged or misrepresented depending on the intent. Because I'll give you a simple example. There's a real estate company whose net worth, when I was looking at that point of time, was less than the money they've raised in the market. Yet every year they had shown the profit. So where did the profit go? The whole thing was, prior to this IFRS accounting standard, they would merge their loss-making subsidiary with themselves and the losses would be directly debited to the reserves, which is the retained earning part.
Right.
So
right.
there was a botoxification, I would say, of the balance sheet. P&L, the losses never hit the P&L. And at the same time, the capital employed shrunk because of the losses directly getting to the reserve. So return on equity looked very good. So if you are just driven by one matrix and you are screening for them, you want to realize that the number ROE is the misleading indicator of both average trend in the earning power of the company as well as the capital intensivity which has gone into the business. Say you are a pharma company and you are developing a molecule. For first 6-7 years you have losses. You write it off through your reserves. Your balance sheets look very neat and trim. And suddenly then you pass the trials and you start making, then the PAT divided by ROE will look very fabulously if you ignore the past.
Right.
So not comparing the numbers across peers and across time can lead to its own consequences. Then this leads to many checks and balances you can do to do accounting. If the assets of the company are growing faster than the earnings and earnings are growing faster than the cash flow, something is definitely wrong. Because EBITDA is not cash flow. EBITDA is your propensity to raise money, how much you can raise in debt. It's not equal to the cash flow. Simple checks. How much is the operating cash flow resembling to the EBITDA? So you just take a ratio of operating cash flow to EBITDA, and the closer it is to 1, better off the earnings are.
Right.
So there are many such checks and balances you can do in accounting to make sure that everything is kosher. And I think so very few investors do it. In fact, Nimesh Bhai, whom I consider one of my mentors, he's clearly stated multiple times that if you can read balance sheet and are numerate about accounting literacy, chances of you making loss through a blowout situation or a fraud or, a company which has overstated its earning power is almost impossible. And I think so you must be aware, Mahalakshmi, that rule number 1 of the game is not to lose money. And
rule number 2, never forget rule number 1. True. So give me a few examples. If you can demonstrate some of this with some of the examples. For example, you called out 1% beverages, you called out DHFL. So what were the triggers for you to look at them in the first place? And how did you sort of navigate and figure out that there was a fraud?
So, first of all, coming to Diwan Housing especially, it was AAA rated company at that point of time. And obviously, almost all companies are either rated or audited or have sometimes many good board directors. So outsourcing of due diligence never works as far as accounting goes. It's always trust but verify situation. Now, when you looked at the company in per se, there is never a profitable wholesale franchise. At the same time, it never had a retail distribution and a cost competitive advantage. So what was the secret sauce was very difficult to figure out. So you started digging deeper. And the first thing to look at is the promoters. What is the promoter secret sauce? And when you looked at promoter, there was complex related party transactions with number of holding companies owning less than 9% of the company, where when you did the cash flow analysis, you knew that money which was raised was being routed back to the company to buy the shares of the company. And there were a lot of red flags about the whole company, the holding structure and the way it was funded itself in the first place. Then obviously the mega issue they did where they raised some 19,000 crore. And we did the due diligence of, sample branches, and the numbers just didn't seem to add up. Then we went to, the whole cash flow. We downloaded the balance sheets of all the related party transactions, really reconciled the cash flows. Took us almost 2.5 months to do that. And we came to conclusion that this company's numbers were not up to the mark. But by the way, let me tell you, that didn't give any result. The stock went up from 200 to 600 after that.
Right.
So in our markets, being early is as good as being wrong.
Anything else? Any other example
again
of
give you examples. Yeah. So again, to highlight the fact that why accounting is critical, let me give you a simple example. Say you are comparing 3 oil and gas companies which are in the business of drilling for oil and gas. Let's assume they are all drilling in the high seas and average well cost is say $50 million. Now there are 2 binary outcomes. Either you strike oil or the oil well is dud. So that 50 million you spend, you have 3 accounting options actually at that point of time. You can choose to write it off. You immediately take a hit on your quarterly earning, and the balance sheet is lean, mean and clean, and investors know this well is all. Does it reflect the true picture of the business? Probably yes, probably no. Why no? Normally, exploration area, large areas, square kilometers or hundreds of kilometers are given, and sometimes the rock formation at that place may not be ideal, and you will have to dig, say, series of 40, 50 wells to realize the true potential of that oil well, the whole gas field, oil and gas field. So, another view could take is, okay, over next 5 years, I'm going to dig 50 wells, and I will capitalize all of them, and then depreciate or appropriate them over a period of time, which is a perfectly fair accounting terminology. But there can be more serious and more aggressive accounting, where you can take a view that the government has said that there is so many MMCD of gas and so many barrels of oil out there, and I will capitalize them and will start expensing them once I start digging and selling the oil, and even that accounting treatment, right? So when you look at the balance sheet and P&L of all these 3 companies, they will look cheese and chalk. They won't be comparable. The only thing comparable will be the cash flow statement underlying it. So if you don't connect the 3 financial statement, you are just focused on either P&L or balance sheet, I think so you are doing yourself a big disadvantage. And numerically you might be right, but then you would be focusing on accounting earning, not true economic earning of the company. Same thing you can say of, say timeshare. You promise to give 25 years of holiday vacations once a week to the customer, and customer is giving you upfront some lump sum money. Now, how is it accounting? Large portion of that is recorded as a period in that year. So there was a company called Sendent in US. They used to account for 80% of the income you gave. Was it an income of that year, or was it a advance which had to be written off over 25 years, which was the
right.
So if you even the top line can be misleading. Forget the bottom line. So knowing how you link the numbers with the underlying cash flow and the business strategy is extremely important. Otherwise it can lead to a very disastrous outcome.
So this is definitely true for one segment of companies where you have long-term liabilities and then milestone payments, and how do you account for that? Can you call out some ground rules? For example, cash flow conversion. Definitely everybody emphasizes the importance of cash flows and looking at cash flow growth instead of looking at earnings. Anything else? 3 or 4 things that you would say, metrics that you need to track without getting into really looking at changing nitty-gritty or changing accounting principles and the impact of that, which is obviously a harder ask, and if you're an accounting professional you would definitely go down that line. But for lots of other investors who might just want to have a basic checklist on how to go about it, 3 or 4 things that you would emphasize.
So Mahalakshmi, that's a very interesting question. So at Flame, where I teach this topic on and off, one of the first important thing I ask all the students and the investors to do is prepare common size statement of the P&L, balance sheet and the cash flow statement. So what does a common size P&L look like? You take revenue as 100% and make everything percentage of it.
Right.
And you do this across time, across peers, across globe. Now, the beauty about it is all the management can't be fraudulent, and some of them would be conservative.
Right.
So when you start comparing, say that there's a telecom company, they both are scaled operation, but they are comparable in numbers in terms of subscriber, but one company is spending 6% of its revenue in depreciation and another is spending 2%. You better know what that secret sauce could be.
Right.
Now, it could be genuine that this company might have imported very costly equipment from Europe with a long life. This company might have imported Chinese imported at lower price, or might have developed it in-house. And there might be some challenges with that also. But knowing that why, where is the deviation across 2 comparable peers or across the same company across time is in fact 80 to 90% of the time you'll be able to come to at least the metrics where you need to focus on why it is so. So there is a saying, right? If it walks like a duck, if it quacks like a duck, it's a duck. So you always there is no scope for aggressiveness in accounting, right, or optimism in accounting, because a healthy dosage of skepticism is required to make sure, because buyer beware, caveat emptor has been the guiding principle for the investor since the times the field of investing has been born. So that's the first thing you can do. Second, as I told you in the earlier part of the equation, is that cost and liabilities are rarely overstated. That means assets and equity are likely to be overstated. So any company where assets are growing very fast in related to profits, and profits are growing very fast in relation to the underlying cash flow, you got to be very sure that, the accrual. What is income at the end of the day? Income is operating cash flow plus accruals, which you have booked but you have not realized. So once you understand that philosophy, you got to start looking for where the mischief can potentially reside.
Right.
So you got to start with the assumption that there's something wrong and prove yourself the reverse way, right? Then obviously you can do a lot of checks and balance, check for the retained equities, check for the, the common. Actually, for a curious student, SEC publishes all kind of, accounting wrongs doing in a very summary every year. You could read about it,
Okay.
Innovation in business leads to innovation in accounting. And regulator is always behind, so they actually publish it. So you could learn from there. And, generally the smell test, it's generally if you start linking impact of any change in a particular item with the remaining two account statements. So link balance sheet and P&L and cash flow. So there are range of ratios you can develop where numerator and denominator come from different accounting statement. When you start doing that across time and across its peers, a lot of deviations come to your life, and then it doesn't take too much time, because once the spotlight is focused, it's very easy to figure out what is the underlying economic substance of the transaction and how it is accounted for. And sometimes that's the right way to accounting, because accounting, Mahalakshmi, has not been designed for investor. It is for it doesn't take off time value. Certain assets are recorded at cost, certain are marked to market. There are a lot of discrepancies out there. So take everything with a pinch of salt and no rigid mindset that everything is fraud and no, everything is kosher. Somewhere answer is in between.
Sure. I'll ask you one question about, ROE, because ROE is like the magic metric, right? Everybody talks about it, everybody uses it, and especially after this, idea of moat, etc. But the easily quantifiable term is really ROE. So how do you look at that? Because you brought up this point that how ROE itself can be distorted or decorated because of accounting principles, because is there any smell test there? How do you, what I have always found interesting is the DuPont model. You just decompose it into 3 parts and see where is the efficiency.
By the way, the person who discovered this model was an engineer also, not an investor. Right, DuPont, yeah.
Yeah. So just looking at the profitability of the business versus the, input-output ratio versus the leverage, those 3 things for me, tells the story. But that also you're saying can be decorated. So how do you look at that? Any thumb rules to see whether this ROE is for real?
So let's just extend ROE a little bit. Let's ask a broader question, that how do management deliver value for the shareholder? So there are very limited way a management can deliver value to the shareholders. Let's go one by one, all of them. They can reduce interest cost, interest efficiency. They can reduce taxes, judicious choice of lower tax havens or policies or, PLI and XYZ. They can increase the margin. So for the same amount of goods sold, increase the price or reduce the cost. Either you be very cost focused, like a DMart, very cost conscious, or a Bajaj Finance, very cost conscious, or very high price, margin, like,
premium pricing like Titan
and so on and so forth. So you need to know whether you are a low cost player with high asset turn or a very high margin player with low asset turns. Secondly is obviously with the same amount of capital you sell more, you rotate the capital efficiency time. The last is obviously you carry more assets on your book relative to the size of equity through financial leverage. There are 2 other cases which are not reflected in this equation, which is tremendous source of value creation is, in my opinion, when company's management changes or changes its strategy to repurpose the asset to the greater good. And that could come through an M&A or a disinvestment or a corporate restructuring or a spin-off or, going private or, selling yourself or something. A tangible corporate action, which is not reflected in ROE. Because if everything was past, then, then historians would be, as you said, the richest. But things are dynamic. It's an unfolding movie. That's a source of captured value, which ROE doesn't capture. Also, what ROE doesn't capture is also, which is one of the secret sauce where largest number of billionaires have been printed in the world, is ability to raise capital from the market at favorable terms. And that includes both debt and equity. That is not captured in ROE. So those are the negatives. But if you then decompose and look at each of the incidences in the business with the lens of this, okay, what is the management doing? And the last is obviously the compounding equation, which is, what is the future value of a business? The present value multiplied by the growth rate raised to the longevity. So the steps management is taking to lengthen the growth period, improve the returns, lower the risk, or what are they? And then when you start looking businesses from this angle, the metrics will pop up, and the metrics will change for different businesses. For retailing, it could be, per square foot, the sales per square foot, and for telecom, it could be output. So you will have to, there's no one formula which fits all sizes or all cases. But once you start viewing businesses from this angle, you can decompose them into, greater metrics, and you can bring each of these metrics into sub-metrics and keep peeling it away.
Sure. So when you started off with the equations, you said there are three kinds of investors. So the first kind of investor you said is, investors who are driven by narratives, and the second kind of investors is by numerics. What's the third kind of investor you were?
Based on how investors take decision to buy and sell the company, there are 5 more varieties of investor. And let me tell you, this is a concept I learned from this book, The Art of Execution by Freeman Shaw, where he says some of the investors are like rabbits. They never sell. Even when they know that company is going to the dogs, they continue to hold, waiting for the price to come up. They never sell. Then he says some are like raiders. Few percentage up, few percent down. Either way, they are out. So a lot of these algo, the rhythmic trading and, market making and short-termism, perfectly fine. Third is hunter. So they don't put all their money at one shot. They gradually keep averaging their price when it goes down. But they have a stop loss that when the price falls below a certain level from the original purchase price, they just get out. Then there are assassins, which he describes that no matter what, cold emotion, stop loss triggered, just realize that market is more efficient, just be humble that market knows more to you, take losses. Many times you'll end up selling good companies, but many times it just saves you. It's very contextual. And the last of the guys are the connoisseur, which, he is probably investing in companies which are great compounders. Time horizon is very long. So there the problem is to deal with the boredom and to make sure you have a right position sizing out there. Right. So depending on this attitude towards investing, you have diversity of this kind of investor class. And it coincides with the diversity of the opportunity set also, Mahalakshmi. Many of us who have been fed of this, Warren Buffett and Charlie Munger, obviously great investor they are. But if everybody chases quality, then who will take care of non-quality stuff? So one thing which I like about what Howard Marks has said is there are no growth stocks. There are only stocks in growth phases.
Right.
Terminal value of almost all business, you can say with certainty, is zero at some point of time. Right? They will cease to exist, will be taken over or go bankrupt. So, and many of the businesses are mean reverting. Remember again the Horace that many shall be restored, which are now fallen, and many will fall, which are in honor. You don't know when. Now, in many businesses, because the way the capital cycle works and the way the investor psychology cycle works, so you are investing in commodities. If you have long-term horizon and long holding power, you'd be dead, because over a period of time, your returns will be just average cost of capital. You'll never output. So there, the timing is the only thing matter. In fact, the only advice you can give is buy when the PE is negative, company is in loss, and sell when the PE is, in 7-8 digit, when it looks cheap.
Right.
And obviously there are caveats attached to it, that in a cyclical you've got to buy companies with lowest cost of production, least damaged balance sheet, and who's expanding the capacity during downturn, so that he is the last person to be taken out.
Yes.
So depending on your investment style, the sell decisions also matter, and there's no, again, one size fits all solution for all this kind.
So tell me about the narrative-based investor. I mean, is there something to learn to make sure that you don't lose money? Reminding ourselves of the rule number 1, rule number 2 of Buffett. When you identify with narratives, and that's the only way. And we see a lot of Indian investors are driven by narratives, definitely at this point in time, because there are so many themes that people are excited about. How do you, while following narratives, are there some guardrails that you can put to ensure that you are not getting totally carried away?
So let's see what types of business opportunities exist in markets, right? There are mediocre businesses, less we speak about them. Nobody wants to buy them unless it's a raider kind. You buy a few percentage up or down, and you are, making algorithmic trades and so on and so forth. News-driven, sentiment-driven, purely. Then there are mean reversion trades, cyclicals and so forth. Then there are companies which are value traps. Your narrative is quite important because they look cheap. Statistical cheapness related to their peers and sometimes the other opportunities. But the important thing is catalyst for renewed growth or reinvestment are missing. Now, most of the investors start screening for stocks by certain criteria, eliminating a lot of fragility and unwanted matrices, and have a universe which is addressable. A small team can manage, because there's only so much you can process as information. So where narrative really helps, Mahalakshmi, is to bucket the ideas and have some common themes for evaluation framework.
Right.
So value traps, the narrative really happen. The narrative is what is the catalyst which will change the cheapness, statistical cheapness. Then there are companies which are good in normal times, but they are fragile, that when a shock comes, they get taken for a ride. Then there are companies which are resilient, means they are resilient to shocks, they remain where they are, but they don't gain from the shocks. Then there are some really great businesses which are anti-fragile.
Right.
That when the chaos hits, they really get competitively advantage. And there are some gruesome businesses which are capital junkies, they keep diluting growth. The growth of theirs is like a cancer.
Right.
So narrative about each company is which pocket they fit is extremely important. Then coming to the great businesses, the narratives is critically important because you are trying to constantly evaluate the longevity of that growth, the size of their cash flow, and the management, which are very difficult parameters to model, Mahalakshmi.
Right.
I don't think you can quantitatively model management pedigree. There are rules, there are checks and balances, there are observations, there are empirical evidence on their capital, but there are no processes. So when this comes, the narrative becomes quite important. But as I said, pure narratives without linking to the numbers and pure numbers without linking to the narrative, both are hazardous. Works well for different category of investor now, but I'm more towards the middle, where every metrics or every qualitative figure gets translated into some metrics which can be more. It could be trend. It need not be a metric. It could be a trend line based number. But yeah, linking the two is quite important as far as I'm concerned.
Sure, I'll take that point. But the challenge really is, how much should you be compromising on something? For example, you never get the perfect combination of growth and value and a good price. We know that we need a business that is great, which is valued attractively, the management is good, but you never get that combination, right? So how do you evaluate and attach weights to various things? And if you can demonstrate that with your own examples of, how did you weigh the narrative versus the numeric? Because even as you do all this deep dive analysis on accounting, etc., in every situation, you might say that, there is this part which I don't like, where, they're not adhering to something. Some things, of course, the easier thing is to say that I'm not getting to this because I know this is going to blow up. But that is eliminated. But the choice of where you would invest will definitely have shades of gray. So if you can give us a few examples of how, 4 or 5 stocks, how you navigated this combination effectively.
So Mahalakshmi, rightly you said, certainty and the price never go hand to hand together, and there will never be a perfect investment opportunity ever in a lifetime of investor. Secondly, there is also a big decision. Once you have bought a good stock, led by a capable management, how long you ride, how long you not sell. That is also a critical decision. And third, and I think so the most obvious one is, narratives are good as a starting point, Mahalakshmi, but they are never an end to itself. And let me illustrate you, as you rightly said, with some examples, that any business which demonstrates superior high return is likely to attract competition very quickly. Let me give you an example. When the telecom business started, there were about, I think so, 26 license holders, circles, Karnataka circle, Maharashtra circle, Punjab. Each of them was highly profitable. Many mergers and acquisition happens. Many consolidation happened. Today you have 2.5 players in the telecom market. And actually, if you look through accounting, only one is profitable from economic earning. And the rest, so there have been tremendous growth of revenue. There has been tremendous scale. There's been tremendous consolidation. But investors as a whole have not gained in the whole process. So, narrative is very good. Telecom, the growth story of India, 130 crore people, the fastest growing market, highest GB. So, narrative looks very brilliant. But when you look at the ground reality and the numbers, that's where numbers help you to distinguish the narrative. If you just go by the numbers, telecom market is one of the hottest market in India.
Right.
But very few players have made money. So that's how you separate the wheat from the chaff. Another examples of how you dealing the narrative versus numbers is you do the reverse DCF. What are stock prices? They are future price expectation about the business embedded currently today, and those narratives are constantly bouncing around medians, right? As the sentiment change, as the liquidity flow changes, as the time horizon. Please remember, Mahalakshmi, our market consists of players with a 1 hour view, 1 day view, 1 week view, 1 month view, 1 quarter view, 1 year view, 1 decade view, and infinite view. When all of them act on the same asset at the same point of time, the difference of opinion is inevitable. And which faction will dominate at that point of time is purely called out by the marginal investor at that point of time. Let me give my own examples. I have owned some of many hundred baggers which I sold early. And you know what was the reason? And it took me 20 years to figure this out. So it's not trivial as for me, that I always used to wear the lens of my own opportunity cost. So whenever stock used to deliver, the profit used to grow, it would become expensive. From cheap, it would become fairly valued, and from value, it would become expensive, and that would invariably create an urge to book profit. It's expensive. It's risky. Little did I realize that at company scale, many things non-technical happen. They get included in F&O. They get included in indices.
Yeah.
They attract institutional investors which require liquidity and consistency and track record. So, as the company scale, you had to look the opportunity cost of the last marginal buyer, not yourself. And in this process, by this simple error, I ended up selling so many of my companies very early because of statistical expensiveness. So
how do you distinguish between the opportunity cost of the next buyer versus the greater fool theory?
Yeah, this is a very loaded question.
Because that also you're just saying that, the next guy is going to be willing to buy at a certain price, and therefore you're okay to buy at a certain price. How do you distinguish?
Mahalakshmi, when you walk down the hall of greater fool, there is a mirror at the end, and that mirror looks at you. So the way I've started to look at it is, whenever there is urge to sell only just for the overvaluation put, I've developed a checklist. That checklist goes something like this. Obviously, you sell when hypotheses go wrong or management does something stupid or competitive advantage position.
Yeah.
All those I'm parking for right now. But just for the overvaluation, if the company is delivering, if the management is diligent, all the factors are in place, and only just market is bidding up, then the flows really matter. So, institutional ownership, liquidity, inclusion in index, inclusion in FNO, all these are trigger points. And those trigger points have to be digested, because otherwise you'll end up selling very early and you will lose the compounding journey. This I've learned very late, after 2 decades of gone, and now I have developed some strategy called foot in the door, where I buy on in small dips anyway when I'm purchasing, but at the sell also you sell a small fraction of your ownership, and you don't just go out and sell completely. And I think so that allows you that psychological comfort to ride the upside. I think so this is what works for me. I don't know what it works for others, but yeah.
Okay. And, what is the other way around? Do you average once you buy, the stock goes down? Are there any principles that you follow while averaging?
Each downside from the purchase price, I don't get anchored to the purchase price, because otherwise that serves as a reference point for the future purchases. But there's one thing, that every significant drop in the purchase price, say 20%, 40%, is a definite trigger for introspection. Because see, in investing, Mahalakshmi, you have to handle bundle of contradiction, like you said. You have to, long-term is series of short-term. You have to be confident enough in your hypothesis that you are right, but at the same time you have to be humble that market collectively knows something better. So all those contradictions you handle. So it triggers off a fresh round of review. As if it's a clean slate inquiry, and as if you are making a fresh purchase initiation. And at the end of the day, if you still come to the same conclusion, I would tend to average. And that has happened in many times. In fact, many of the multi-baggers I've bought actually have fallen after my purchase, and we have added more. In fact, ideally, I would wish that nobody should have very big multi-baggers, because if he has not added to the price as the company delivers and the management delivers, you should be averaging up also. So averaging up is a perfectly rational way of position sizing. Averaging down is not the perfectly rational way of average sizing, unless you are damn sure of your investment hypothesis. This is only given to very concentrated investors who don't mind, averaging down. So depending on your hypothesis, only where
you tend to do it on the way
where
up.
I've come to assessment that there are forced sellers which are selling for reasons beyond the fundamentals. Those are the only times I've averaged down.
Okay.
Where I've genuinely proved myself, selling is happening because of the forced selling. It could be a levered promoter, it could be leveraged investor, it could be financial crisis, it could be some spin-off has been announced and the FIs want to get out of the stock because it's very small, it's not part of indices. All those technical reasons would make you average at the down for sure.
But you don't question the wisdom of the market. That's what you're saying.
Every act of investment, partially you are questioning the act of market, because it's a act that you know something better. Again,
No, if you're not able to, match it with any technical reason,
then
means there is some wisdom in the market
then
which you
wisdom
will
in the
not
market.
challenge.
Then there's a wisdom in the market, yeah. Market collectively are quite efficient and getting more rational than rational.
And even while you are averaging on the higher side, are there intervals that you plan upfront, or how do you do that?
So Mahalakshmi, we did an exercise. We took all the great BSE 30 and NSE 50, all the companies which were a part of index at one point of time, and we went through their history. Can you guess what was the difference between the high and the low of the share price in any given year, median high and low price? Greatest of the stocks and the worst of the stocks.
I wouldn't know, but 50?
39%, 40%. So, market tend to give opportunity for patient. As long as you have stability of capital, no stress decision-making environment, it keeps giving you opportunities to keep buying good businesses at regular interval. And many of the businesses sometimes consolidate for 2-3 years. This is where nothing happens. So yeah, opportunities keep coming up, and you keep taking advantage of it.
Cool. And you talked about value traps, right? So again, what are the questions you ask? How do you decide whether it is a value trap or not?
So value traps are statistically very cheap and very alluring. So first question to ask to the God is, why God is so kind on you only? Why you are the only one who has this tremendous insight that this stock is cheap, and the others, all the people, competitive, hyperactive, hyper smart, intelligent people in the market are ignoring this company. So I'll give you an example currently. You say company like Reddington.
Sorry, company like
Reddington.
Right.
Extremely cheap on multiple better. Is it a value trap? Is it a melting ice? Or is there an embedded growth optionality? Can the company have a growth phase? Can company come out with some new product offering which can introduce growth and allow it to recapital? Now, this is a dynamic exercise. It can't be looked at as a still picture. You have to revisit the hypothesis every few intervals. And one of the two checkpoints of the value traps are they typically don't tend to grow more than the nominal GDP, and they can't reinvest their cash flow. So they pay out a lot. So then the question only remains is, what is the catalyst which will change this? Introduce growth and allow them to reinvest the capital which they are throwing off.
So if there is no trigger, you don't.
ITC was one classic example. It became the famous meme stock.
Yeah.
It had great cash flows. It was like 210 and 220. There would be memes flying around. But so, what is the catalyst which will change that narrative? Is what the only sole focus at the time of whether to participate in a seemingly value trap.
Could you call out any catalyst at all in ITC? Because it was just natural progression where, taxes faded away and then volumes in cigarettes started to go up. So was there any particular catalyst that you could have pointed out and say, okay, this is when it is going to turn and therefore let's position ourselves?
Management also said, management felt pressured. They said they would do value enhancing exercise like consider demerger of hotel business and so on and so forth. Sometimes I just think it was a classic case of ESG example taken to extreme. The sin industry, where a lot of just fund managers took a call on the societal impact of the business and sold. So I didn't have any ITC, but I'm just giving you an example. I think so. The real culprit behind this was the framework with which the fund managers were evaluating the sin business side of the ITC. And at some point of time, market said damn to this and it took off.
Fair enough. So what has been your best investment so far and how did that come about?
The best investment so far is not the one where I've made the most money or where the IRR is the most. Actually, it is a stock where I took the least amount of risk. And let me tell you, this happened in post-2000 Ketan Parekh scam. So, Unit Trust of India, UTI 64 scheme had to be wound up, and they had a stock of a company called Burroughs Wellcome. It doesn't exist anymore because it got merged with Glaxo. And they were constantly selling it. And it was below book value. Now, here's a company owned by GlaxoSmithKline Beecham group, very reputed group, IP driven, not a single year of loss, very high dividend, very high ROE, trading below book value. So what was the catch? Secondly, Glaxo's return on capital, Glaxo's dividend per share, Glaxo's ownership in Wellcome, Burroughs Wellcome was higher than Glaxo. But Glaxo was a larger liquid name. So it used to trade at 4 times the valuation of Burroughs Wellcome. Now worldwide, Burroughs Wellcome and Glaxo had merged. But in India, the merger had not happened because 2 employed had filed some case. And pending the case, the merger couldn't be consummated. So we went and we met those workers. It was some frivolous case requiring some 15 lakhs of payout. And we knew this would settle at one point of time. So we took a very large aggressive position. I was managing offshore fund at that time, and we almost went up to 9% of the company without reaching the statutory limit of 10%. And immediately, that problem got solved. Merger was announced. For 1 share of Burroughs Wellcome, we got 1.7 shares of Glaxo, and Glaxo was 4x valued than Burroughs Wellcome. It It was one of the least riskiest investment with the very impossible zero downside and unlimited upside. The way I look at it, I think that remains the best investment we have made so far.
Okay. Any other investments that exemplify your way of thinking? I'm sure it applies to every single investment, but something that you're really proud of.
There are some stocks which hold dear because of the serious fact that I had the conviction to hold them for more than 2 decades. 3 stocks come to mind, Gujarat Fluoro being one of them, Bharti Telecom being another of them, Bajaj Finance being another of them, like almost 2 decades of holding period. The fact that I could...
So you said Gujarat Fluoro, Bharti and?
Bajaj Finance.
Bajaj Finance.
The pleasure is you could hold for nearly 2 decades.
So that makes me very curious because you just spoke about telecom, saying that, a good part of telecom, the growth has happened, but then, returns have not come through. So what makes you keep your faith in, or what has made you keep your faith in Bharti?
The trick was I didn't hold the Bharti Airtel. I hold the parent unlisted company Bharti Telecom before it went for delisting.
Right.
Basically, we acquired Bharti Telecom
when it was listed in the Delhi Stock Exchange
at a market cap of 180 crores.
Right. So that's the share you hold now.
That's the share we sold to when they took out all the minority shareholding through they consolidated the shareholding. We almost held it for almost 18, 19 years.
So you don't hold it now?
No, we sold in that.
So when did you sell?
2015, 16. I think.
Okay. So when you sense that the dynamics of this business will change,
it was fairly valued. It had become part of index. Competitive intensity was going up, geo and all. It was time to take profits.
Okay. And when did you sell? Do you still hold Bajaj Finance? Okay. What makes you keep faith?
Company is gaining market share. Company was a monoline, only catering to the captive of Bajaj. And by the way, in 2006-7 period, I think so. Even management didn't subscribe to the warrants. By the way, market cap was less than 400 crores. NPA was 12%. Everything wrong was happening. But the change in management happened where Nanupam Nani and Rajiv Jain really, took the biting, provided for the losses. They started diversifying away the company. And today you have some 30 lines of business, each of them growing. Housing finance, they just in 5 years, they scaled to almost 1 lakh crore. So A, market share. B, candor in communication. If you see, I think so they have one of the best disclosure norms in the financial industry. Thirdly, very early adopters of technology. Very transparent with investors. In fact, during the COVID time, they were the first to call out that it would have a significant impact on the... As the company scale again, I've realized now that investors like a sovereign wealth fund who are happy with 4 and 5% return would also enter the stock. So that knowledge has helped you. It's expensive, but knowing that the margin of buyer.
In points like this, for example, where do we have clarity on the competition intensity that it might be subject to with a new player coming in? Second, how do you justify this kind of, valuation discrepancy? I mean, it is expensive, but it is way more expensive also.
Mahalakshmi.
The scale is bigger. So there are so many things on paper, if you see, will be stacked against Bajaj Finance, but you're holding faith.
So Mahalakshmi, financial services is the second oldest business in the world, right? Been time immemorial. So, and competition keeps coming in and keep going with regular intensity. It's the easiest business to enter, right? And hundreds of Indian corporates have entered and failed. It's a business of execution, number one. Number two, it has the highest profit pool, even now. If you look at globally, the financial services sector has the highest profit pool as of right now. And highest market cap also. We think technology is it, but it's not. It's the financial services because it captures profit pools from several industry. Number two, it can reinvest the profits. It generates at scale. And Nestle can't. Hindustan Liver can't. If they start doing it, they would be forced to do funny things. So, A, you can redeploy capital. Third and foremost is, if you really look at it, study every country whose per capita GDP has grown from $2,500 to $10,000. The single biggest beneficiary of that move has been financial sector. We are at means while it looks that there is a 20-year of financial services compounding in various stocks like Kotak and HDFC and Bajaj's of the world, we are at 2,500 per capita GDP, which is the threshold at which your basic goods and needs are taken care of. Food, shelter. You have a propensity to prepone the consumption and pay for the EMI. So I think I firmly feel the golden periods of it for the financial industry till that. And at that point of time, it will become highly overcrowded and highly penetrated. Right now, penetration is in peanuts. What is mortgage penetration in India? It's barely touched double digits. So there's a long runway to grow. It can redeploy capital. ROAs are fantastic in spite of the capital. And you have a fanatic, intelligent fanatic driving the business. So you keep... it's expensive, but you keep holding. It's not a decision one has to take every day.
Fair enough. So now the third question I wanted to ask you, like the broad questions, is how do you avoid mistakes? Any equations to avoid mistakes?
Another loaded question. There's a litany of things which can go wrong, but let me simplify the conversation for you. What is the essence to compounding? Future value is present value. Rate of growth, longevity of growth, exponential. Let's look at each of them. Present. So buying, if you overpay for an asset today, base rate will kick in and you can't have disproportionate growth from that point of time. Remember Wipro, like this example which comes to mind in 2000, its market cap became some percentage, 1 or 2% of India's GDP. After that, company has continuously increased profit, increased dividend, but yet the market cap probably has barely come. I don't think so it has come to the level it reached, if my memory serves me right. Or barely come there. But there was a 20 years holding period where stock, if you had bought at that point of time. So anybody who says that growth stocks can be bought at any price is not been a student of history. Because if you look at it in the Nifty 50 era where, all the banks were allowed to sell the mutual funds in the market, there was a list of these 50 stocks which could do nothing wrong. They included Johnson & Johnson and IBM and Pepsi's and their P multiple went up to an 85, 90, and in next subsequent 20 years they went down to double-digit P multiple and investors lost 80 to 90% of their wealth.
Yeah.
By the way, there's a corollary to it. If the investor had held in for subsequent 10 years, they would have still beaten the index. So holding period and the stability of capital and mind also decides that. What else?
So would you count that as an underappreciated risk? The fact that, you hold today also in the context of India, there's so much premium attached to high quality that long periods of underperformance can drag down your overall returns. Is that something you would appreciate as a risk?
So if you look at Hindustan Lever, there have been 10 years period where stock has not gone anywhere.
Right.
So future price is a function of present price paid, and margin of safety only can come from the attractive price in relation to the size of the cash flow and the timing of the cash flow. Look at the second part of the equation, which is the rate of growth. What makes you entitled to superior returns time and time, quarter and quarter, year and year, decade and decade again? It is only if you have some sustainable, competitively advantaged business. You are operating in a low-risk environment. And mind you, Mahalakshmi, many of these economists and the theoreticians say high returns don't come without high risk, but it's exactly wrong. In fact, most of the time, high returns come with very low risk because the management is taking steps to have a business conducted in a very low-risk manner. And how do you conduct business in a very low-risk manner? Once you have a good product with competitively advantaged position, the only way to management can do is conduct a win-win game where they are always winning with their vendors, with their customers, with their regulator, with society, with their investor, with their banker, with their employees, so on and so forth. And third is constantly reevaluating whether the management is creating fresh optionality of new S-curve growth by either expansion of product, expansion of geography, changing product mix, and so on and so forth. With this framework, you can evaluate what to do. Anything else which either makes business fragile, or you get into win-lose function, or you have a defective management, or you get into a very defective decision making should be avoided. So there is a litany of factors I can get you to tell you what to avoid. But ultimately they are all things which hurt either longevity of the business or the competitive advantage of the business, or you will end up overpaying. If you avoid these three, I think so end results are very good for an average investor.
Fair enough. I mean, avoid overpaying and paying the right price. I think it takes a lifetime to understand that, though simply put. So some quick questions. Are you a morning person or a night owl?
Mostly a morning person.
Okay. What is your daily information diet?
The information has exploded. In fact, the needle, the product which I'm working on, is a byproduct of managing that information product. Over a period of time, we have realized that there are certain people who give you right information and there are certain right sources, and you just tend to limit reading habits to those sources and those people.
So what do you read every day, apart from annual reports?
We normally, I tend to read some blogs, because there are some writers who do it out of love and affection and not for commercial consideration. I read a lot of history books and the management books. One of the satisfaction of learning is, let me put it in a very curious way. Businesses are run by people. They serve people. Asset prices are set by people. Regulators are people. Everything is people-driven business at the main. And there are centuries of people who have lived ahead of us and gone through various things. Let me give you an example. When the COVID crisis struck, I read the article in The Economist, actually, which says they had studied since 13th century all the wars and all the pandemics till 2018, and they had clearly stated next 5 years of a pandemic results into unprecedented boom. Now, if you had read that and had history or knowledge at that point of time, you wouldn't be so worried about. You wouldn't have acted like a frozen baby, taken some cash call and done something stupid. So, reading about history, reading about business is one of the most satisfying thing, apart from balance sheet and research reports.
Tell us 3 blogs that you read. You mentioned blogs.
Fernham Street,
Okay.
25 IQ, compounding quality. There are some list of 400 resources which
25 IQ, that 10 Griffin. 10 Griffin, okay.
Statutory
Right.
reports by Scott Goll. There's some good writing. I'm a fan of long form reading, so I like deep dive. So I tend to generally read long form content.
Okay. And how many hours do you read every day?
That's all I do, Mahalakshmi.
All right. Do you believe in luck?
So I had the fortune of meeting Peter Kaufman at Glen Eyre, and somebody had asked this question, and I think so his answer is bang on. Somebody had asked him what is the reason of success. What are the factors which contribute success? And his answer was 8% skill, 25% courage of seizing the opportunity at right time, and the rest 66% is the luck. But with one proviso: harder you work,
The luckier you
luckier
get. Sure. How much of your success do you attribute to luck?
I think so the ratio would remain same, more or less.
All right. An error or a mistake that you have been prone to. I mean, what has been the hardest thing for you to correct?
Analysis paralysis. As you said, there are no perfect investment, and sometimes I overweighted factors which never played out. And you ended up making an investment. There are many of them. Acts of omission. They never appear on your balance sheet because you never acted on it.
Right.
And the act of commissions are the ones I told you, premature selling, because of your perceived expensiveness in relation to your opportunity cost, which I think I figured out that now you have people with differential expectation, differential liquidity needs, differential return expectation, and they are the one who set the prices. So yeah, those are the two ones which hurt the most.
Fair enough. Your sounding board for investments.
Lucky to have good mentors, some of them who are dead, whose writing inspire you, some of them who are alive, whom you open to meet. In fact, after this, I'm going to meet few of them. Nimish Bhai and Durgesh Bhai have been good role mentors, and then I've learned a lot from them directly. There are many people I've learned from, and I've been just lucky to.
But any one person whom you use as a sounding board for your investments, if you're just, too confused about an investment, you're not able to decide.
Is Durgesh Bhai at time?
Durgesh Bhai, okay. Investors whose moves you watch closely.
I'm not a fan of cloning investment because you can't borrow conviction. The only thing that can matter is the starting point. They could just be a pointers to a good business which may not have come to organization. So many times presence of a stock in somebody's portfolio just serves as a trigger,
right,
to have a look. But beyond that, I know for sure you will be taken out if you are living on borrowed conviction.
Sure. 3 Indian investors you admire.
Radhakishan Damani, Nimish Shah, and Chandrakant Sampat.
Okay. And 3 any contemporaries?
I wouldn't want to go on record should they do something stupid down the line. So let's park it for a later date.
All right. Okay, now this is also tricky. Any contemporary you would trust your money with?
There are few investors.
Come on, you can take a shot at this.
If I was no longer managing on my money, my advice to my wife, the widow at that point of time, would be to put half of the money into index funds and don't touch them till the time she needs the money, and half I would distribute over 5-6 relatively unknown fund managers who operate in very specific niches.
Tell me the names so that I can get them for the wealth formula.
One of them is Keshav Garg. He sits in Pune, very understated guy, diversified microcap, the breadth which I can't think of. Another is Viraj Mehta at Equirus. He is good. But there are many bright stars emerging. But my essential condition of evaluating would be young, very energetic, operating in a niche, and doing it for passion and fun and not for money. Those would be my yardstick.
Fair enough. 3 investment books that have influenced you the most. Of course, we know the classics, so keep them aside.
So if you don't want me to go for classics, the book would be Devil Takes the Hindermost or Hindsight, which talks about risk framework. Another book which really seriously influenced me was Understanding Michael Porter by John Margarita. The way to analyze the businesses was very good out there, and the third book would be Poor Charlie's Almanac, not too considered classic, but I think so. The wisdom per page is, I think so, the most densest in that book. Actually, I've read it 6 to 7 times, and still I learn again. I think so I should read it again very quickly.
Sure. Wonderful talking to you, Kuntal. Thank you so much for your time.
Thanks
today.
for having me over. Thank you.